Welcome, everyone. I'm Angelo Robles, host of the Angelo Robles podcast and the founder and CEO at Family Office Association. Today, we're going to cover an analysis of the Biden tax plan. It features Charles Lowenhaupt, chairman and partner, Lowenhaupt Chasnoff, and director of Lowenhaupt Global Advisors Australia. But he's not joining us from Australia now, although I'm really not sure where he is. Charles, how are you?
Angelo, thanks very much for that introduction. And I like the second part of the introduction better than the first. In the first, you said you were going to kick me off. I think you were going to get me going. I'm not used to being kicked off. It's a pleasure to be here today, Angelo. I think glad to be speaking to members of the Family Office Association. I respect that organization greatly and actually think it's one of the premier family wealth organizations we have.
So kind.
If not the most premier. So here we are in 2021, and Angelo says I'm going to analyze the Biden tax plan. In fact, what I'm going to do is talk a little bit about what you do and how you have to think in times of confusion. 2021 is our first Biden year, a Democratic House and Senate. We're hearing daily of threats to completely overhaul the taxation of private wealth, and that overhaul does not look very favorable. Indeed, the theme we hear is that those who are rich should pay for all of the improvements needed. There are a lot of improvements needed, and the way that it's seen the rich should pay for it is through taxation, revenue taxation, as opposed to inflation taxation. What are the threats? We read about them regularly, but I thought it'd be worthwhile setting them out. One is raising federal income taxes as high as 39.6%. Not to mention that there are limitations still in place on the deduction of state and local taxes. And there are other various taxes on income, most notably the state and local taxes. So another proposal floating around is raising capital gains taxes from 20 to almost 40%, and add to that the Affordable Care surtax of another 3.8%. They're proposing lowering the estate tax exemptions. Right now, that's 11.7 per person or 23 for a couple. They're talking about lowering it to 3.5 million for a person and 7 for a couple. They're talking about severely limiting the annual gifts or the number of annual gifts. That's the presently, I think, $20,000 per donee with an unlimited number of donees. They're talking about limiting that number. They're talking about repealing the step up in carryover basis at death. The fact that when a person dies, his assets are revalued at date of death, and that becomes the cost basis. They're proposing that that be repealed in some way or another. They're talking about limiting the 1031 exchange. They're talking about all sorts of so-called loopholes, like the grantor retained trusts, and closing those loopholes. If we put all this together and we add the increase in the corporate income tax, what we're going to see is one of the most significant restructuring of tax laws in 20 or 30 years. And lawyers and accountants and the IRS will be busy for years to come. I've seen a kind of scurrying about what to anticipate, what's next. Private wealth holders seem to be the targets, and all of us need to be concerned. Lawyers and accountants are sharpening their pencils. My emails are full of seminars and programs. What's the new law going to look like exactly? What planning will be available under the new law? Marketing efforts have started already, so law firms and accounting firms may well be reaching out to you to tell you what you should be planning and what new wills and trusts you're going to need. Unfortunately, rather than simply raising tax rates, which would be a logical way to raise taxes, what they're doing is talking about completely revamping everything, leaving everything you may have done as a wealth holder or you may have advised as an advisor in disarray. And rather than trying to tell you the details of what will be enacted, it occurred to me that it would be helpful to set out some 7 principles that are worth considering as you deal with the confusion and wait for announcements as to the precise details of the new tax plan. In other words, some thoughts of how to cope, what you should be doing in times like this to look ahead. And I'm going to base it on the longer sweep of history. My grandfather was the first lawyer in the US to decide to concentrate at income tax. He opened his firm in 1908. He had 6 years before the federal income tax was enacted. He watched the 16th Amendment enacted, authorizing the income tax. He saw the enactment of an estate tax in 1916. He saw the enactment of a gift tax in 1924. My father was also a tax lawyer. He saw the dramatic increase to pay for World War II. He saw an excess profits tax and numerous tax reform acts. I got into the picture in the early 70s. I've seen the introduction of the generation skipping transfer tax, actually 2 of them. And at one time, I guess I may still be the longest serving chairman of the Generation Skipping Transfer Tax Committee of a section of the American Bar Association, as we tried to ride the bucking bronco of the first generation skipping tax. So I thought I'd share with you what my family has learned over these 113 years, focusing on tax law for 107 years, really, since 1914. Saw the first federal income tax. And to give you a kind of broad outline of what we've seen the enactment and the repeal and the reenactment of estate taxes. We've seen the enactment and repeal and reenactment of gift taxes. We've seen the enactment and repeal and reenactment of generation skipping taxes. We've seen increases, decreases, even repeal and replacement of the capital gains taxes. We've seen rate changes, rule changes, and every other kind of change you can imagine. Obviously, you can see that one thing you can always count on is that everything changes, and it changes over and over. Congress does not care about your convenience. Congress does not care about the convenience of the advisors who have to scurry around and try to tell you what to do. And Congress does not care that the tax laws will be enacted and then changed, often in just a year or 2. They don't care that there are going to be proposals that get changed over and over and over again before they're even enacted. So I'm not going to try to advise you how to replace your GRAT or what amendments you'll need in your wills and trusts. I have no crystal ball, but I am going to guarantee that there will be many, many, many changes before enactment, and no one can be sure what they'll be. So instead, as I say, I'm going to set out several principles, I think 7, which have held up in one way or another over the past 107 years. Here is the first and primary principle. You should start by answering the starting question, what are you trying to make your wealth do? What goals will taxes impede? Fellow came into my office some 10 or 15 years ago, and I asked him why he was there. He said he was there to save taxes. And I said, we could do that. We've been doing it then for 100 years. I said, but before we get to that, I want you to tell me, you've told me what you don't want your money used for, and you said taxes. And the question is, what do you want to use your money for? What is your wealth for? The moral here is don't figure out how to save taxes. until you know what you're saving them for. Here's a clear recent case. We have a very wealthy client who came to me some years ago and said, look, my children are rich. My father and grandfather left them lots of money. They don't need any more money. I want my entire estate to go to charity. I said, fine. And we've written all of his documents to leave everything to charity. He called me last week, furious at the Democrats. He's always furious at the Democrats and terrified of what they might do to his wealth. When he finished venting, he said, what shall I do about this situation? And I said, do nothing. It's most unlikely that Congress will keep you from giving to charity. These tax changes are unlikely to interfere with your desires or your plans. So what is your wealth for? And how would tax changes interfere with your purposes? And that's the first principle. Here's a second principle. Don't count on grandfathering provisions, but don't rule them out. Grandfathering provisions make changes prospective only. They give people time to change their wills and trusts and take their capital gains and so forth. And as a general proposition, in fact, as an absolute proposition, grandfathering provisions are equitable and pragmatic in tax legislation. Rules affecting estates and trusts and estate planning, they're not fair, if that matters, unless they exempt trusts that are now irrevocable, or estates of people who die before they can change their wills. So estate tax laws often give you time to change your documents. If they don't, it can be very dangerous to try to change your documents. I just heard a talk by a very astute estate lawyer who gave all of the problems with changing wills and trusts to adjust after the fact to tax changes. With capital gains taxes, there's a very good pragmatic reason to make those prospective only, because if you make them prospective, people rush to take their capital gains, and there's a big bump in the Treasury revenue. Makes much more sense than making capital gains changes retroactive. This way they can get a bump in the tax revenue. What does that mean for your capital gains tax holding? Client came in a week ago. He knew he was going to sell some securities that had about $100 million gain built in. He knew he was going to do that in the next year or two. He said to me, when should I do it? I said, I think you should do it right now. There's a good chance that any capital gains tax increase will be prospective only. And if it's not, selling it now won't cost you any more than selling it in a year. So he's done it. He's sold it. He's recognized his capital gains taxes. It'll be about $20 million. It's clear capital gains taxes aren't going down. What does that mean for your estate planning? Well, you would have been very wise to use your lifetime exemption in 2020. That was $11.7 million last year. Will it be 11.7 million this year? Hard to tell. Would you regret using it this year? Might it go up? Unlikely. So it might not be stupid to make your substantial exempt gifts this year right now. Here's a third principle. Speaking of gifts, making gifts is almost always tax advantageous. I'll emphasize the tax in that statement. It's tax advantageous. The gift tax was repealed from 1926 to 1932. Some of the largest trusts we work with today were created in those years, and they've continued over the entire period with no estate, gift, or generation skipping taxes. It's been a period of extraordinary appreciation. And those people who made those gifts between 26 and 32 made a very wise decision. I don't propose the gift tax will be repealed. I don't think it will this year. But even without repeal, gifts almost always make sense. Tax-free gifts are pure giveaways. That's the annual exclusion of 20,000, which they talk about limiting. That's the lifetime exemption of 11.7 million. So those are giveaways. Do it. Paying gift tax isn't so bad. The gift tax is out of your estate if you live long enough, and all appreciation between the time of the gift and your death is likely to pass tax-free. Here I'd tell you, beware of any strings attached. If you retain any interest, such as the grantor retained trusts, Congress is going to go after you. The gift tax is exclusive and the estate tax is inclusive. You don't pay a tax on the gift tax. You do on the estate tax. I can illustrate that. Suppose you've got $150. You can make a gift of 100, and assuming the tax is 50%, the government gets $50 and your children get $100. If, on the other hand, you die with that 150, the government gets $75 and your child gets $75. That's with the same 50% stated rate. With gifts, the tax is exclusive. With an estate, it is inclusive. Again, don't retain any control. The IRS and the government are always going to be going after you. So make gifts. Here's a fourth principle for you. Look at your overall tax implications whenever you're planning anything. It may well be that accelerating an income tax will save estate taxes. Expressed differently, what looks like a high tax may not be so high. Go back to our client who recognized 100 million in capital gains taxes, or in capital gains, that's 20 million or so tax. The tax of 20 million looked pretty high to him, did to me too. But if he hadn't paid that tax on 20 million, it would have cost the estate 10 million in estate taxes. So a 20% capital gains tax only costs the heirs 10%. Not such a terrible tax. Similarly, a gift tax paid long before you die, as I illustrated before, costs your heirs only 50% of the gift tax after the estate tax is considered. We have had some very interesting experiences with the generation skipping transfer taxes, I should say, some very experimental experiences, because there are ways where you can skip 3 or 4 generations with only 1 generation skipping transfer tax. It takes having a fair amount of disposable assets, but once it's done, that gift seems to go on for great-grandchildren and beyond, maybe great-great-grandchildren, with no further tax. My 5th principle is what goes around comes around. I'm no political scientist, but I do observe that taxes get reduced under Republicans and increased under Democrats. I expect the Republicans will come back again sooner or later, and some people may want sooner and some people may want later. In 2001, a law was enacted to phase out estate taxes altogether. And if you were lucky enough to die in 2010, or maybe better to have a parent die in 2010, there was no estate taxes. We actually ran into some heirs who encouraged the doctors to pull the plug in December of 2010, because sure enough, by 2011, the estate tax was coming back. So it disappeared for a year. I've already mentioned the gift tax disappeared for 4 or 5 years. In 1976, Congress enacted carryover basis, no step up in basis of death. How the law worked couldn't be figured out. The IRS, Congress, taxpayers spent 2 years trying to figure it out. And so 2 years after it was enacted, it was deferred another 2 years. And in 1980, 4 years after it was enacted, it was repealed retroactively. So no one ever had carryover basis. And that's because no one could figure it out. Apparently we're much smarter now, so we're going to try again. It's a little different that we may end up taxing capital gains at death, which is actually historically and philosophically makes no sense, but we can talk about that if anyone's interested. In 1976, Congress enacted the first generation skipping tax. And for 10 years, as I mentioned, I was intimately involved. No one could figure out how to make it work. In fact, the IRS couldn't even figure out a generation skipping transfer tax return. So from 1976 to 1986, we had a law no one understood. By 1986, there hadn't been one generation skipping tax return filed. So that law was repealed and replaced in 1986 with the one we have now. Those of our clients who went ahead and made gifts that were subject to the 1976 generation skipping tax ended up with trusts that will never be subject to a generation skipping tax. So they ended up with exempt trusts and are very happy they did it, even though as they did it, it looked like they were doing it under a taxing scheme that was never going to change. Here's an interesting concept that's always helped me, and it leads to the sixth principle. It's old-fashioned, and today no one ever uses it. I learned it from my father, and he learned it from his father. And about 10 years ago, I got a call from a reporter asking me for a citation that would discuss the history of this concept. I couldn't find one, so maybe it was just one my father and grandfather developed. Here's what it is. It talks about the iron ring of taxation. The iron ring of taxation. What does that mean? It means that the creation of income, property is taxed. That's the income tax. At the receipt of property by gift, there is a tax. At the receipt of property inheritance, there's a tax. So the income, gift, and inheritance taxes all together form an iron ring of taxation. What is not taxed and cannot be taxed is the destruction of property. The income property is taxed, gift property is taxed, inherited property is taxed, but destroyed property is never taxed. Always look for a way that the destruction of property in the hands of one person increases the value of property in the hands of another. I'll give you an example. This is a real life example. There were 2 copies of a rare book, only 2 that existed. Each was worth $100, and one man owned both. I'll say I owned both, but this was actually a client. I give one copy to my daughter, and there's a gift tax on $100 because that book is worth $100. I burn the other copy. Now, I don't burn books. I don't think that's appropriate. But instead, I give it to a library, a rare books library, takes it out of the market, effectively destroys its market value. When I do that, my daughter has a book worth $150. It had been one of 2 worth $100 each, but when there's only one left, it's worth $150. The destruction of the value of the book given to the library increases the value of the other. I'll give another example. Say I'm a plumber with Lowenhaupt Plumbing, or I'm a lawyer with Lowenhaupt and Chasnoff, which is more accurate. I don't know how to change a pipe. But meanwhile, I have a son who starts a company called Lowenhaupt Plumbers. I then start telling my customers, as Lowenhaupt Plumbing, that I'm slowing down. I take my name off the web, effectively destroying my goodwill. But when these customers look for me, they find my son, who's got a company with a very similar name, and as destroy the value of my business, the value of my son's business increases. In fact, my grandfather did that with my father, and my father did that with me. And there was no way the IRS could figure out to tax the destruction of property. Similar plans can be designed around investment assets. And we've done that. You can do that with charity. You can do it in any number of ways where destruction of value increases value in the hands of someone else. So that's the sixth principle. It's the iron ring of taxation. Look for the destruction of property. Let me emphasize one overriding principle. It's my seventh and it's my last. Never take irrevocable action if you may regret it later. Don't do what you may regret. Now, when I say you may regret it later, it may be they change the tax law and you owe more taxes, something like that. I don't mind those regrets. What I'm talking about is you shouldn't do what may prove to be substantively bad. I'll give an example of that. About 30 years ago, a very large accounting firm designed an absolutely brilliant family limited partnership. The arrangement was brilliant. The paperwork was hundreds of pages. God knows how much it cost. And they made it for a man and his sons. The man and his sons were estranged. The son's mother hated the father, and the children hated the father. Now, the accountant set it up with every I dotted and every T crossed, and tens of millions of dollars were placed into this family limited partnership. The father, partly out of spite, ran the partnership business into the ground. The children, and we worked for the children, sued the father for fiduciary violation. The lawsuit went on for 2 years. Between the father's behavior and the lawsuit, much of the partnership value was lost. So the appreciation that was supposed to go to the children wasn't there. And it looked like the father had everything, except when the courts got involved, the courts made the father pay the children very substantial amounts. And the children ended up with whatever value was left and further substantial payments for damages. The success there was that the children ended up punishing their father. But I'm sure the father regretted that very brilliant family limited partnership. That's an example of what you should not do, no matter how much you may save in taxes. I'm reminded of an old man who had a trophy wife. I was a young lawyer and I was meeting with him about his estate planning and his taxes and future generations, so on and so forth. He kept falling asleep and I kept telling him, mentioning his estate, that would wake him up. And all of a sudden he looked at his watch. It's around noon. He stood up and he said, "Charles, I got to leave." I said, "Well, where are you going?" He said, I have a golf date with my wife. And she's a very beautiful woman and I don't want to keep her waiting." And I said, "Well, that's fine, but what about your children and your grandchildren and estate taxes and probate and all the things we have to discuss and resolve?" And he looked at me as he put on his coat and hat and he said, "Listen, Charles, what's posterity ever done for me that I should worry about posterity?" And out the door he went. At the time, I thought that was terrible. Though the older I get and the more I see that posterity is not doing much for me, the more sympathetic I am. So that seventh is never take irrevocable action if you may regret it later. A very important proposition. All of these ideas require discussion with your advisors. Don't decide what the law will be before it's passed, and don't let your advisors tell you what the law will be before it's passed. Don't let them make assumptions about the law. Whatever you do, weigh any risks against the rewards, and don't do anything you may regret later. I think Angelo's left us a little time. If there are any questions, maybe somebody out there will tell me exactly what the new law is going to provide, and then we can forget my 7 principles and start drafting like crazy. But thanks for your time.
Well, thank you, Charles. That was really fantastic, incredibly insightful. There is one question that came in a while ago in the chat feature from our live audience. So while I'm asking Charles it, and perhaps some of my follow-up, I highly encourage, part of the benefit of being a live participant is you could ask the questions that you want to ask, at least via the chat feature. So please do so. The question that was asked, if they eliminate GRATs, what happens to a GRAT that has been formed in the past or a GRAT that is formed in 2021?
Well, the answer is they want to go after it. That's the question that gets to the question as to whether it should be prospective. And if it's not, if these laws are effective on the date they're enacted, we're going to have total chaos, because it means your will's out of date, your trust's out of date, your irrevocable trust. There's one proposal to tax irrevocable trusts every 21 years, no matter what. Many of us put a provision in trust that the trustees can change them to take into account changes in tax law. But these are changes that'll be very hard to take into account. So the answer is sit back and see what happens. And the answer for planning purposes is to look at different approaches to estate planning, analyze the extent to which what you're getting out of the GRAT could be gotten out of a charitable remainder trust, or charitable lead trust rather. Keep looking for ways to destroy property.
And relative to the Biden tax proposal, and I know it will undergo some level of back and forth, but there is going to be some things that families of wealth and success relative to their income are not going to like. 1031 exchanges are integral to the real estate community and valuable to be a real estate investor. To think that that could be totally ripped out, I mean, that is cataclysmic. That could be huge. I don't want you to put on a look at a crystal ball and let us know which direction it's going to go, but talk a little bit maybe about what that could do to real estate.
Well, it'll have an effect on real estate, Angelo. Sometimes, though, these things all sort of sort out in one way or another, never will. What strikes me, and I'd really emphasize this, in 1914, when the income tax was enacted, there was a philosophy. What is income? When is it realized? When is it recognized? All of these laws they're fiddling with now, or all of the provisions they're calling loopholes now, really had sound philosophic grounding. When the estate tax was being considered originally, a number of lawmakers said, look, this isn't fair. You're going to tax the fair market value, and you're not going to give a credit for the cost basis. So in fact, unlike a capital gains tax, you're taxing the whole value of the property. And Congress said, well, what we'll do is make the estate tax roughly half the rate of the capital gains tax. It was understood that an estate tax was instead of a capital gains tax. When they then come in and say the capital gains tax, or when they say the step up in cost basis is a loophole, they're ignoring the philosophic grounding of the estate tax. Similarly, in the like kind exchange, the theory was if you're really going to stay with the same kind of asset, and at one point I think it applied to exchanges of stock too. If you're going to stick with the same kind of asset, why recognize a gain until you move out of that asset class? Now they say, oh, there's a loophole. Any of these provisions seen as a loophole are really just ignoring calling them a loophole is ignoring their history.
And maybe the other question, I mean, effectively doubling capital gains is a massive increase. Again, I know that we'll likely have some level of a compromise, but just think of the impact that could have for those that maybe own assets that have appreciated via capital gains. Let's use stocks as an example. Maybe people hold on to them longer, hoping that the next administration something changes. So the velocity of capital and money, I don't want to make it a deep discussion on macro and economics, although I did want to bring a little bit of that in. And again, I know it's the crystal ball like we just did on the 1031 exchange, but that's a massive prospective capital gains increase. And what impact will that have?
Well, put that together with the increase on corporate taxation.
That too.
And the reason you do that, when the capital gains tax was repealed, and I've forgotten the year it was repealed on the basis that capital gains are simply a reflection of corporate income, which is already being taxed. So it's a double tax. In addition, it's frequently a tax on inflation, and that didn't seem fair. So there are good reasons for no capital gains tax, and basically compromise has historically been to reduce the rate on capital gains. When they increase the rate on capital gains and they increase the rate on corporate income, they're making investment in common stocks much less attractive. And if anything, they're making, I would think, particularly for families of wealth, it reinforces the idea that you should hold on to assets long term. It's certainly going to discourage active trading.
Yes. I mean, at the end of the day, many presidents are elected depending on the general enthusiasm for how someone's doing. Am I employed? Am I satisfied? Do I see things improving? What's the future for my children? And what's the direct impact on me, which taxes play a lot into it. And the markets have skyrocketed over the last year. At the end of the day, they, meaning the Democrats in total control now, probably want to continue that looking 2 years out and potentially 4 years out. But this is a touchy football. You have the economy and how that impacts people. But again, the top 1%, their voting volume is a hell of a lot less than the other 99%. This is the typical football and challenge, throwing it around that we all have. And I'm not saying that I have a perfect answer.
Well, and to some extent, we have to take into account the fact, and I don't have the statistics here, huge amounts of investment assets are held in tax-exempt entities.
Right.
Whether it's retirement plans or pension plans or charitable endowments. And secondly, huge amounts of investment assets are held by non-US persons. And that also makes a difference. So what percentage of the population is actually impacted by increased capital gains tax isn't entirely clear. My guess is there are many more beneficiaries of tax-exempt plans than there are people who own substantial portfolios in securities.
I mean, we've been having this discussion for years, but COVID and the impact of people in greater New York and California for a variety of reasons going to Texas and Florida. So looking at some of these proposals and just looking in my backyard of New York, higher federal, we have state, we have city, if you're in New York City, the Obama tax. I mean, I start to add all that up and I know there's going to be deductions and getting creative, I get it. But on the surface, that's well above 50%, relatively similar in California. You would think this would be a boon for places potentially, although it sounds modest, but for people making a lot of money, it adds up in Texas and Florida, and it has been. Will that trend continue?
I think so. We've gotten calls from clients in California and New York who run numbers just like those, Angelo. And they say, what are we going to do? It's up to 60, 65%.
Oh, God. Yes. I mean, I love California. It's the most diverse state, from topography, from deserts to ocean, to Silicon Valley to LA. It's a beautiful drive, golf at Pebble Beach and all that. And yes, for some people of great wealth, it's worth it for them to what they perceive as giving back via taxation for them to have happiness, for lack of a better word. And that's fine. Everyone can make their own decision. I do have a comment slash question. It's meant to be a little comical and tongue in cheek, but not too comical. But it'll probably get a chuckle and you could say I'm crazy. And my audience is going to hear me ask this to upcoming economists and others that we have on. Why do we have taxes at all? Meaning, if you follow modern monetary theory, which we're kind of going through now, just print away. Print away to pay the government's bills. Why do we have taxation as individuals? Could I make the point that going back to that 1914 and the powers that be, that this is simply a tool to control the people?
Well, that's an excellent question. I'm not chuckling, but I'm going to answer it in two ways. First of all, when we talk about taxes and we're referring to the taxes enacted by Congress as part of the Internal Revenue Code, those are revenue taxes. If we didn't have any of those and the government printed away, we'd have inflation. Inflation is itself a tax. So the question is, where do you want your tax? In the devaluation of the dollar or in checks paid to the IRS? Next, Angelo, I would point out that in 1913, when Congress was debating the income tax, there were three arguments against it. Let me make sure I can remember them. The first was that it would be confiscatory. The second was that it would be complicated. And the third was that it would require an army of investigators to enforce it.
They succeeded.
And the answer was, first of all, the income tax we're proposing is only 2%. Congress would never be so confiscatory as to enact a tax of 10%.
Of course not.
The second was, the American people are the smartest people in the world. Everyone will always be able to prepare his own income tax return. It will be very simple. We will never require a preparation industry to help people prepare their return. And the third was, the American people are the most honest people in the world. We will never need any government agency to enforce the tax laws.
You should be a comedian, Charles.
Yeah. Well, I was going to say, there are more chuckles there than why do we have a tax law at all?
Yeah, that was a good one. Good ones. Yeah, I mean, this is something we could debate and go back and forth. And it's a subject I will be bringing up to others that we have on. But given that your family history going back generations and tax law, literally to when here in the US that was enacted, I believe during Woodrow Wilson's presidency, and doing a little research on it, that question, again, a little tongue in cheek or comment slash question. I mean, there's definitely a foundation of truth to it that can leave you scratching your head. I don't mean to sound like Mr. Libertarian here, and everyone's entitled to their own opinion, but don't just accept what the talking heads say. Actually go back and study history, do some research, and form your own thesis. Learn to think all for yourselves. Hopefully I just spark, I hope, some interesting discussion with great guests, and then you're able to go out, meaning our viewers, our listeners, and kind of do your own thing and make your own decisions. Like I said, I don't see any further questions yet coming up in the chat feature. I suppose we're heading a little bit to the home stretch. I may give the audience 2 more minutes before I go into a close. But Charles, why don't I give you the honors now of kind of relative to your commentary, my questions, your feedback, and anything that you might have left off the table that you want to conclude with.
Well, what I would conclude with, and I think it's been on the table, but it's worth keeping in mind, as bad as it looks right now, and as bad as it will look when they enact whatever they enact, what goes around comes around. The next time we have a Republican administration, and I am not a Republican, nor am I a Democrat, there will be repeal of all sorts of things. It's the fact that there was no estate tax in 2010. It's the fact that the capital gains tax has been repealed in our history. and reenacted, the gift tax, the estate tax, everything's been enacted and repealed. So as bad as this may be, hang on, develop whatever strategies you can develop to make it a little less painful, and things will change.
That was a great summary and conclusion, and actually gave me a little bit of hope. Very good advice, as I expect nothing less from Charles Lowenhaupt. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles podcast and founder and CEO at Family Office Association. It really has been a pleasure to have Charles on. I didn't have a chance to say it at the open. I've known him for many years. He really is in the family office world, and not just here in the US at all, as you saw via his title, but his work in the Far East and Australia really has been amazing. He's incredibly well traveled, has a long history in this, and his deep experiences over decades. He's been a mentor and really a deep thinker to many of us in the community that I've had a chance to learn so much from. So truly, that has been my pleasure. Charles, and I know from your perspective, it's not as much from the business side of things, but for those that are intrigued by your comments, want to read more of your work and learn more, how could they do so?
Well, I've written a couple books called Freedom from Wealth and the Wise Inheritor's Guide to Freedom from Wealth. But in addition, Angelo, if they can find my phone number, they're welcome to call me, email me. Always happy to talk about more. I write pieces every once in a while. I think those appear on various social media sites.
Of course.
And I'm always happy to talk about these things. You know,
Yes, Charles, please.
you reminded me of an overarching concept, which we didn't really touch on. About 20 years ago, I was lecturing at the law schools in Shanghai and Beijing to these young Chinese who were just coming into private wealth. And I'd open by asking the question, what do you think in the US is more threatening to private wealth? Taxes or foolishness? And they all said taxes. And I told them they were all wrong. I've seen much more wealth lost in foolishness than in taxes. So I'd encourage your members to keep that in mind. It's a fundamental principle I didn't put in my 7.
That is a great principle for everyone, I hope, to understand and realize. And I like how Charles makes it where, you have to do a little work, which is pretty easy work on the internet these days in terms of finding and reaching out. But that's Charles Lowenhaupt, Lowenhaupt, chairman and partner at Lowenhaupt Chasnoff. And as I mentioned too, director of Lowenhaupt Global Advisors, Australia. So you could find him. I highly encourage it. He's a wonderful thought leader, as I noted. And as I mentioned, the host of the Angelo Robles podcast, meaning me. And my website to learn more about our organization is simply familyofficeassociation.com. I recommend that same name for Instagram, where I do a lot of unique writing before it makes its way into my traditional work and master classes. So again, that simply is Family Office Association on Instagram, and very active on YouTube as simply Family Office. So go check it out, subscribe, learn more. Charles Lowenhaupt, this has been incredible. Thank you so much for your time.
Thank you, Angelo.
Thank you.